Hello everyone, thank you for joining us. In our recent article on transfer pricing audits, we focused on the treatment of intangibles by the Nigerian tax authorities. In the past 3 years, there has been a significant increase in TP audits by the FIRS. TP audits usually commence with the FIRS request for documents, after which, depending on some considerations, the FIRS may proceed to the interview stage, where its officials speak with key personnel of the taxpayer and then sends a report summarizing its position on related party transactions. Taxpayers and the FIRS then have a series of reconciliation meetings to agree on the treatment of these transactions. From experience, we have noted that despite the taxpayers' efforts to defend their positions, sometimes the taxpayer may eventually have to compromise and adopt the FIRS position on certain complex transactions, such as intangible transactions, due to their unwillingness to proceed to litigation, which is generally lengthy and expensive, considering the absence of judicial precedents to guide the treatment of the transaction. Globally, intangible transactions are a source of TP controversy due to their complexity, as tax authorities are usually skeptical about them. So what are intangibles? An intangible, as defined by the OECD, is something that is not a physical or financial asset that is capable of being owned or controlled for use in commercial activities, and whose use or transfer would be for compensation if it occurred between independent parties in similar circumstances. Compensation for the transfer of right to use an intangible used to be hinged on the legal ownership of intangibles, but after the revision of the OECD guidelines in 2017, the right to earn returns now depends on the functions performed, assets utilized, and risks assumed towards the development, enhancement, maintenance, protection, or exploitation of the intangibles, commonly known as the DMP functions. There are two broad categories of intangibles, and they are trade intangibles, which includes patents, know-how, trade secrets, etc., and marketing intangibles, which include trademarks, trade names, customers list, etc. The remuneration for the transfer of intangibles depends on the nature of the transfer of rights and the profit that the intangible drives. For example, where a marketing intangible drives revenue of the licensee because of significant brand recognition, the remuneration is typically a royalty rate as a percentage of the licensee's net sales or revenue that the intangible is driving. For trade intangibles, especially where there is the use of proprietary formula or technical know-how, the FIRS may want to establish that those intangibles were not used during the production process, especially when significant manufacturing activities does not take place in Nigeria. Also, in the event that the taxpayer purchases raw materials or semi-finished goods from its related party for resale, where intangibles are also involved, the FIRS may want to establish that the purchase price of the raw materials or semi-finished goods includes the royalty, and therefore royalty cost should not be paid to the related party. In addition, the Regulation 7 subsection 5 of the TP regulation restricts allowable deductions of royalty payments on intangibles to 5% of EBITDA plus the intangibles consideration. This provision is deemed inconsistent with the arm's length principle, as it does not factor in the arm's length price in determining the restriction. Other considerations are discussed in detail in the article. To read more on our article, please subscribe using the button below. Thank you.